Hello and welcome to another stock analysis on Stock Market Palantir. Don't forget to put your comments and subscribe. Okay, now let's go hear our analysts.
Welcome to the Stock Market Palantir. Today we are going to talk about
DNN.
specifically Denison Mines Corp. And we're focusing on them because they're in such a fascinating spot right now. I mean, they're an Athabasca Basin uranium developer right at the center of structural energy demand, a huge regulatory moment, and just all this market noise.
And that noise, that volatility is really the story of the day. The stock is trading, right around that 275, 280 level. It actually broke some key support back in early November.
Exactly. And what's so striking to me is the market structure itself. I mean, it is deeply fragmented. The amount of trading happening off exchange is, it's extraordinary. We've seen short volume consistently over 50%, and it even hit, 55.63% on December 5th? Right, and that complexity, the high volume, the market fragmentation, these huge binary regulatory events on the horizon, that really frames the central question for anyone looking at this stock. Is DNN's valuation being driven by its own strong fundamentals, the operational de-risking they've been doing? Or is this high beta price action just a function of these big external macro narratives, like the whole nuclear AI connection and these opaque market structures you just mentioned?
I'm firmly in the second camp. I think it's predominantly external right now. My stance is that its correlation to tech news, combined with all the maneuvering happening in dark pools, those are the forces that are really controlling the price. The stock's trading like a proxy asset first and a uranium developer second.
See, I see the evidence for that, but I think that view kind of overlooks the massive quantifiable progress the company's made on the ground. My position is that the real long-term value here comes from their operational execution. All this volatility, to me, it's a temporary dislocation that's hiding the fact that management has pulled off a huge de-risking strategy. It's positioning the stock for, frankly, an explosive re-rating once this last regulatory piece falls into place.
Okay, so let's dig into that. You believe they've basically eliminated most of the internal corporate risks.
I do. Look, DNN is a fundamentally sound, event-driven story, and maybe most importantly, it's fully capitalized. They're sitting on about $720 million in liquidity, cash, investments, the works. That means they are fully funded to get to their final investment decision, the FID, in early 2026. They don't have to raise dilutive equity in this kind of market. And beyond the money, the biggest non-technical hurdle, the social license to operate, that's largely been cleared.
You're talking about the CNSC hearings.
Exactly. The imminent CNSC Part 2 hearings from December 8th to the 11th. They've been massively de-risked because of the Impact Benefit Agreement, the IBA, they signed with the Metis Nation, Saskatchewan. That takes a potential opponent and turns them into a partner. It's a huge win for project certainty.
That IBA is definitely a critical piece of risk mitigation, I'll give you that, but let's look at how management has used that confidence in their capital structure. You brought up the financing from August 2025, the convertible senior notes. The initial conversion price was set at $2.92, which is right about where the stock is trading now.
And that's where you see the real signal of insider confidence. Management didn't just stop with the convertibles. They overlaid a capped call strategy. Now, for anyone unfamiliar, a capped call is basically a financial instrument the company buys that acts like insurance. They spent $35.4 million to protect existing shareholders from dilution, all the way up to an effective share price of $4.32.
And what does that mean practically?
It means management has literally created a dilution-free zone between $2.92 and $4.32. They are signaling with tens of millions of dollars of capital their conviction that the stock is going to appreciate substantially after they get regulatory approval. Otherwise, why would they spend $35 million protecting against dilution they didn't think would ever happen?
Okay, I accept that the capped call is a powerful signal of internal confidence, but internal confidence doesn't shield a stock from external market shocks. My thesis still stands. The valuation right now is tethered to this high beta AI infrastructure theme, and that makes it vulnerable to noise that has absolutely nothing to do with the Phoenix deposit.
I'm just not convinced that AI Nexus is a systemic factor. Give me some hard evidence that this correlation is more than just short-term noise.
We saw it plain as day on November 3rd, 2025. DNN dropped 9% in one session. And what triggered it? Reports that Chinese AI firms, I think it was DeepSeek, had found major efficiency gains in training models using less power. So the market did this very simple reductive math. More efficient chips equals less power demand for AI, and therefore less need for nuclear power. It was a classic narrative shock.
But that interpretation completely ignores established economic theory. It flies in the face of the Jevons paradox.
Okay, let's clarify what that paradox means here. Because I agree the market's reaction was flawed, but the reaction itself is what proves my point about the stock's sensitivity.
The Jevons paradox basically states that when you increase the efficiency of how you use a resource, it often leads to an increase in the total consumption of that resource, not a decrease. So if AI compute gets cheaper and faster, its adoption across every industry, drug discovery, manufacturing, you name it, it just accelerates exponentially.
Exactly. More efficiency leads to massive scale-up, which ultimately drives power demand even higher, requiring more baseload. But the critical takeaway for investors is that the stock sold off because of the efficiency news. The fact that the price reacted more to a headline about Chinese chips than it did to, say, the successful IBA in the Athabasca Basin, that shows the narrative connection is volatile and, for now, it's dominant.
So if we accept that volatility is driven by this external positioning, we have to ask where it's happening. You pointed to the fragmented market, with over half the volume off exchange. How is that structure influencing the price?
Well, it means price discovery is opaque. It's being heavily influenced by institutions positioning themselves in dark pools. These are, alternative trading systems where huge blocks of shares can trade anonymously. So whether institutions are quietly building a massive long position or executing short strategies, this structure minimizes their market impact. It leads to this kind of price suppression or stability that just frustrates a pure fundamental valuation.
And that brings us right to the core of our debate. I want to start with that last point, interpreting these opaque market mechanics. You see the high dark pool volume as suppression or instability. I think it's much better interpreted as institutional accumulation ahead of a known binary event.
I'm sorry, I just don't buy that wholesale. I mean, sure, large buyers use ATS to buy, say, 5 million shares without spiking the price. Of course they do, but we can't ignore the short activity. You would argue that a lot of that off-exchange short volume is just internalization by wholesalers to facilitate retail buys.
That's right. Internalization is just a mechanism. A broker-dealer fills a retail buy order from their own inventory instead of going to the public exchange. So when a retail trader buys 1,000 shares, the wholesaler might internalize it and then hedge their own books with a synthetic short position off exchange. It's about providing liquidity. It's not necessarily a bearish attack.
I understand the mechanism, but the data points to something more aggressive than just hedging. We have to look at the fails to deliver, the FTDs, as the real signal of market instability here. This isn't just volume. It's a failure to actually settle trades.
Can you just walk us through the significance of that data?
Absolutely. We saw a massive spike. 1.25 million FTD shares on September 29, 2025. That was right when the stock was trading near 317. An FTD means someone aggressively sold shares that they didn't have and couldn't borrow by the settlement date. It creates a deficit that regulators eventually force them to cover.
So you're viewing that FTD spike as evidence that momentum was being capped by, what, naked shorting?
Absolutely. And when the clearing firms are eventually forced to settle those fails, usually T+2 plus a grace period, it creates guaranteed forced buying pressure to cover that non-existent inventory. We saw another big spike, over 500,000 FTDs, on November 5th, right after that DeepSeek news. This history suggests that any positive regulatory news won't just cause a gradual price rise. It will trigger a chaotic, aggressive unwinding of these positions.
I can see that the structure points to potential volatility. And while the current 10% short interest isn't at the classic squeeze level, that's usually above 20%, you're right that the combination of that FTD history and the tight 2.05 days to cover, it suggests a very rapid, aggressive move on any good news. The volatility is baked in.
So let's circle back to the first point then, the regulatory risk.
you mentioned the IBA and the strong provincial alignment, which is fair. But are you underestimating the potential costs of compliance that could still hit the project's bottom line?
I'm not really convinced by that line of reasoning. I think the risks from other interveners are incremental, not existential. They're manageable.
But have you quantified them? I mean, groups like the Birch Narrows Dean Nation and the Athabasca Denisuline First Nations have intervened, and they're asking for specific enhanced conditions. This isn't just talk. They could mandate specific caribou protection measures that affect construction windows or expensive long-term water monitoring that goes way beyond what Denison planned.
And while those conditions will add costs, they won't derail the project. The provincial approval from Saskatchewan back in July provides very strong regulatory alignment. Look, it's just very, very rare for the federal regulator, the CNSC, to flatly reject a project the host province has already signed off on. Plus, Denison has crushed the timeline risk. They've reported that engineering for the Phoenix ISR operation is 85% complete. They are genuinely shovel-ready.
Okay, that engineering progress is laudable, but investors still need technical proof that the ISR method itself will actually work in the unique Athabasca Basin geology. I mean, historically, that geology, the hard rock, the specific water pathways, has been resistant to the kind of standard ISR they use in, say, Kazakhstan. That technical hurdle is still a massive risk.
But they have provided a powerful technical proxy that substantially reduces that perceived risk. We just need to look at the success of the Sabre mining method at the McLean Lake joint venture nearby, where Denison has a stake.
How does a different method mitigate the risk for the Phoenix ISR?
Sabre, it stands for Surface Access Borehole Resource Extraction, is this proprietary method using controlled blasting and high-pressure water jets to get at high-grade ore. In Q3 2025, their operations there achieved an average operating cash cost of around $19 a pound.
That is incredibly low, especially when you compare it to the spot price, which has been in the $76 range.
Precisely. That operational success proves that Denison can access and process high-grade ore in this difficult geology without having to resort to crazy expensive underground mining. It's a proof of concept. It shows they can manage the geology profitably, and it significantly lowers the technical uncertainty around their plans for Phoenix.
That data point, the $19 cash cost, is probably the strongest evidence I've heard for your position, because it speaks directly to technical competency. But let's use that technical certainty to revisit the market noise, specifically the corporate history.
Ah, yes. We have to address the reverse split myth. It creates so much unnecessary confusion in retail forums.
It's a persistent confusion, and I think the fact that the retail base is so focused on this specific piece of history is really relevant to the stock's volatility profile.
The 2006 event was not a distressed reverse split. It wasn't a struggling company trying to avoid being delisted. It was a strategic M&A deal, a merger between International Uranium Corp. And the original Denison. Old shares were exchanged at a 2.88 to 1 ratio to consolidate assets and form the company we know today. It was a corporate restructuring, not a desperate act.
And clearing that up is crucial, but let's pivot to the retail sentiment today. The fact that this investor base is tracking every regulatory milestone, like the October 8th hearing date, and that they view the dark pool activity as intentional price suppression, whether that's true or not doesn't even matter. That's a huge factor. It creates this highly convicted investor floor that acts as support, but it's also what makes their reaction to news, good or bad, so intense. It just exacerbates the overall volatility.
So, to synthesize our discussion, for me, it still comes down to the fundamentals. The trajectory for Denison remains anchored to the structural uranium supply deficit and the incredible economics of the Phoenix deposit, which have been validated by that technical success at McLean Lake. Management has de-risked the corporate side with the IBA and, crucially, signaled massive confidence with that capped call up to 432. The company is, I believe, poised for a significant re-rating after the final regulatory sign-off early next year.
And I have to reiterate that while those fundamentals are impressive, any investor has to accept that DNN is currently trading as a hybrid asset. It's part mining developer, sure, but it's also highly sensitive to the high beta AI macro narrative. And until the CNSC decision resolves that binary risk, the stock price is going to remain susceptible to external noise, like that efficiency shock, and it will be subject to the influence of institutional forces in this fragmented market, which, as those FTD spikes show, just consistently generates instability.
So the essential challenge for the investor, then, is balancing the quantifiable asymmetric reward that management's conviction presents with the inherent structural volatility caused by this collision of the regulatory clock and these powerful external market forces. There's clearly more to explore in how these technical advancements will ultimately be priced into a market that is so dominated by sentiment.
Thank you very much for hearing us. Let us know in the comments what is your opinion and if you want us to analyze other stocks. Don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.